Most of the market is private. Most of the market is non-public. So if investors, especially ultra net worth investors, if they're not participating in the private markets, they're kind of missing out on literally 90% of the equity opportunities on a global basis.
Hello and welcome to this special episode of WPTV. My name is David Katai, Senior Editor at Wealth Professional. In the wake of our 2026 Wealth Professional Awards, WP is highlighting a few of our excellence awardees, showcasing the insights and approaches that earned them their place at the award show. Today, we have one of the excellence awardees for the Centurion Asset Management Award for Advisor of the Year Alternative Investments, Thane Stenner, Senior Portfolio Manager and Senior Wealth Advisor at Stenner Wealth Partners Plus of CG Wealth Management. Thane, welcome back to WPTV.
Pleasure to be with you, David.
The obvious question coming out of this is why do you think you were named an excellence awardee in this category?
Well, I think historically, candidly, I've done a lot of alternatives over the years and done a lot of due diligence on alternatives. So it's a space that I do believe I know very well. I used to also work with Morgan Stanley, and I was part of their alternatives advisory board in the US. So again, this is an area in a space that I've been participating in, our team's been participating in for well over 25 years. So it's an area I think we get called upon and seen as being highly recognized in the space.
Mm-hmm. And how, given that expertise, how do you use alts for your clients?
Great question. I would say to try to generate alternative income streams or growth streams that are less correlated to the broad, equity markets or bond markets. So, alternatives, you'll say, well, okay, what are alternatives? I basically classify them as anything other than the stocks, bonds, cash markets. Anything that kind of plays outside of those three buckets is considered, in my opinion, basically alternatives. It's to generate different revenue streams or income streams, as well as to lower the volatility of an overall portfolio.
Mm-hmm. You just hit on something that I've heard from a lot of different asset managers, and especially alts asset managers, is that it is an incredibly broad category. Anything that's not on public markets or cash, that's most of everything, Thane. So how do you go about explaining the various categories of asset classes that you're leading your clients into when you invest them in an alt strategy?
So let's start off with this. When it comes to, for example, the equity markets or the stock markets, for example, the private equity markets historically right now is something to the tune of 90% of the global market. So most of the market is private. Most of the market is non-public. So if investors, especially ultra net worth investors, if they're not participating in the private markets, they're kind of missing out on literally 90% of the equity opportunities on a global basis.
Mm-hmm. That's an excellent point. I'm curious as to some of the other categories as well. How do you kind of talk through the difference in private debt assets versus public debt?
Yeah, so private debt, there's two things when it comes to private debt strategies is because they're less liquid than the public fixed income side, obviously. There should be a risk premium and a yield premium associated with it. So right now, as we speak, the 10-year US government bond yield is around 4.36% as of today, whereas private debt instruments will be generating anywhere between 7 to 12%. So right out of the gate, you're getting a yield advantage, but you're giving up liquidity for the most part, and the risk profile of the underlying debt is obviously higher too. So risk reward, it's a balance of how do you generate higher rates of return? Well, you've got to take on more risk, and you've got to do it with less liquidity in the fixed income markets.
You've talked about how you use these, but I'm curious, your practice, and we've spoken about this before, is really focused on the high net worth and the ultra high net worth, and it's quite a select cohort of clients. So given the goals that those clients tend to have, how do you find an alt strategy serves those client goals?
Especially for ultra net worth investors, because they've got more zeros in their portfolios, or more commas, I should say. Basically, again, it kind of comes back to how do we generate returns even when the public markets are maybe misbehaving or more volatile. So we're trying to give them a return profile that's smoother. And at the end of the day, allows them to still participate. They're already wealthy by their nature as to their net worth. So getting back to them being able to handle more illiquidity, the wealthier you are, the more, you don't have to have everything liquid, right? So whereas $1 million portfolio is very different than a $10 million portfolio, which is very different than a $100 million portfolio. So for, as you kind of move up that wealth curve area, basically you're able to sustain less liquid holdings because you don't need everything to be liquid. So it creates more opportunities for you. At the end of the day, it creates more opportunities for you.
The other piece is, when you talk about income streams coming out of this, the tax consideration is always a piece for advisors to deal with, and especially when it comes to high net worth and ultra high net worth. So how do you use alts to make sure that your client's income has tax advantages?
Great question. So I'd say, on the alternative debt side, that's interest income that's fully taxable. On alternatives like covered call ETFs, for example, so ETFs that have option strategies wrapped around them, that generates dividends, but also capital gains. So capital gains, as David, are basically taxed at basically half the rate of what interest income is. So if you can generate income on strategies like covered call ETFs, you're basically create a more tax efficient profile, especially for ultra net worth or high net worth investors that are taxed the highest tax bracket, right, in Canada. So the tax alpha that comes from these types of strategies tends to really come from trying to blend different income streams together that have different tax treatment. But you can't get away completely from the highest interest taxed or income tax treatment of interest income. So we don't condone going fully non-interest bearing because you have to have more certainty inside the portfolio. So you get this blend of income that's interest, cap gains, return of capital, and deferred gains is really the ultimate way of doing it.
I've heard a lot of people use the expression of, don't let the tax tail wag the dog. But at the same time, if there are ways to find tax advantage to lower some of the tax burden for your clients, it still serves their goals accurately. And it would seem like this is a route that you've used to achieve that.
100%. We've got one discretionary strategy we call the alternative income strategy portfolio, which has been top ranked against all the popular fixed income benchmarks. In that portfolio, it's got about 40 different holdings. Underneath those 40 different holdings is literally over 7,000 holdings globally. So in there, we've got, fused together a number of different types of strategies. We want to try to give for the income profile investor, we want to try to give them a smoother return profile as well. So again, you have to construct it and design it in a way to bring together the attributes that smooth the returns, generate very good returns. But again, you don't go all one type of income stream. So you're absolutely right, David. You can't let the tax tail wag the dog in this situation. You've got to design the portfolio where there is some, tax leakage every year, but that's the cost, quite candidly, of generating a higher income.
Yeah. I mean, it's the thing of you could, I guess, if you had all your money in a corporation, you could pay yourself at the lowest tax bracket, and then you would have to live on an income at the lowest tax bracket. That comes with the territory.
Correct.
The other piece when we talk about alts, and it comes with sort of the rollout of alts across the retail channel, it was often presented as almost following the innovations of the pension fund industry. And we saw, the Maple 8 was the notorious notorious is the wrong word, but sort of considered the innovative leaders, the ones who invested in infrastructure, who bought into all these private market strategies. And now retail channels have been given more access to alts. There are the advantages that alts give to pension funds. What are some of the advantages that you would say alts give to retail funds and that are unique to retail investors?
I'd add one thing about the leaders in the space. One of the leaders globally was the Yale Endowment Fund by Swenson. And then the Maple 8 kind of followed on, as did Harvard and a bunch of others. So you're right. They kind of led the charge. But when it comes to the retail, especially the alternate net worth retail, at the end of the day, it's opening up a bigger box of tools to try to generate returns. That's ultimately what this is about. And, as far as the strategies, you mentioned infrastructure, there's a tremendous amount of strategies. There's music royalties, for an example. There's a lot of different strategies that you can put to bear. And I think the secret is retail investors or alternate net worth investors need to understand you're giving up some liquidity. Like, you don't get something for nothing in this world, right? At the end of the day, you're giving up something because you're not as liquid with a bunch of these strategies. And they've, in some cases, been probably over marketed as being, still liquid or, semi-liquid, when the reality is they should be presented as, no, you're in this for 5+ years. You should be committed to owning it for at least 5 years. And if you're looking for stuff that's more liquid because you have a need for the capital at some point in a year or 2 years, you shouldn't be owning these by capital. Mm-hmm. You have other liquid investors, and you're going to take lower returns because of that liquidity need. So basically, my message would be really simple. When it really comes to alternative strategies, you've got to take a more of a business cycle approach, investment cycle approach, where you shouldn't be looking to tap those particular pools or buckets over the next 5 to 7 years.
And it's interesting, you talk about applying these to a high net worth and ultra high net worth clientele who are often entrepreneurs themselves. And I guess how does the understanding of their own wealth is coming from what was built through, again, business investments that take time, that take a long time, that involve a commitment of a certain period of time. How does that maybe help you in positioning these investments?
It's also a really good comment. And that's exactly what we try to do every day in our conversations with clients, saying, like, when you were building a business or when you were structuring an acquisition, you ended up, did you go with variable rate debt if you bought out a business, or did you go with a 5-10 year structure to kind of create more certainty? And invariably they say, well, no, we would have a longer term debt structure to create certainty to our acquisition. I go, exactly. It's exactly what you want to try to do, is to structure things with a longer fuse to them and a longer time frame. And that generally that kind of the ball drops, right? They kind of go, okay, got it, understand. And I say, when you're doing let's say they buy a business and they do a vendor take back. So that's a form of structured credit or structured fixed income in essence, because you're lending the money to the seller and you're off taking that. And at some point you expect to be paid, right? So there's risk to that underlying investor not paying. But at the end of the day, if you diversify the portfolio across hundreds or thousands of different holdings, that's how you minimize your risk.
Final question really is for the other advisors who are watching this. And, I guess what I'd ask is, how should those other advisors be thinking about alternatives now? And how should they be thinking about them also in the context of, the unique needs of high net worth and ultra high net worth clients around tax, around estate, and around income?
That's a multifaceted question, David. I would say alts are not going away. They're going to increase. Alts in Canada, the alts exposure on advisor books, the latest numbers I've heard is around 5% of books are in alternative investments. Pension plans basically have, loosely defined, probably 40 to 50% in alts. In the US, from where I worked when I was at Morgan Stanley, books down there, advisor practices would have 15 to 20%, up to 25% alts. So Canada has a lot of catch up to play, candidly, in the alternative space. So I don't expect that trend. It'll have bumps along the way like it has on some of the gating issues that have come out. But I think for the most part, if you're properly structured, you diversify the positions for clients, it's something that's going to be a mainstay in portfolios, I think, for decades to come. As far as how it interplays with, their estate plan, taxes, and, income requirements, obviously, if you can get higher income using alternatives, that's potentially a very good thing. As far as taxation, if you blend it properly and you mix it properly, you're going to you're going to reduce your tax leakage. You're going to increase your tax alpha on client portfolios, which is a positive thing. Because at the end of the day, it's what after tax, at the end of the day, is what really matters to a high net worth or ultra high net worth investor. As far as how it plays into the estate planning, that's interesting because sometimes people say, well, if somebody passes away, there's some illiquidity on some of these things. True, but that's also the case with, I don't know, real estate. Real estate can take some time to unwind. If they own an apartment building, it takes some time to sell. So there's liquidity that can kind of come into an estate. I've been an executor, unfortunately, twice now in my life. And you just simply have to work through that. But I think, none of us plans on dying soon, although it can happen. But when it comes to the estate overlay to your investment portfolio, obviously, if you're 80, you have to think about it more seriously. If you're 50, 60, 40, in that range, you're still having to invest the long term in mind. So alternatives fit, I think, in the buckets as long as it's part of an overall diversified strategy. And I think it can be highly accretive.
Mm-hmm. Okay. That's an excellent message to end on, one that brings in so many of the themes that we've seen through the industry as it continues to evolve. So all I can really say after that, Thane, is thank you so much for taking the time and sharing your insights.
My pleasure, David, as always.
And thank you to all of our viewers for WPTV. I have been David Katai. Have a great rest of your day.